Good morning, ladies and gentlemen, and welcome to the show this Tuesday, the 23rd of November, 2021. Thank you for watching the show, and I'm glad to have you guys here. Now, we're going to get into a little bit deeper dive. Now, yesterday I was talking about how I expected the Fed will get away with their first rate hike. Not rate hike, but their first taper. There's going to be $10 billion less bond purchases and $5 billion less in mortgage-backed securities coming right away before the end of the year, I get what I gather. Why they're going to get away with the first one, probably even the second one, I'm going to get into more depth and detail about why I believe they're going to get away with the first couple without the markets turning over. But when the markets turn over, they're going to turn over quite suddenly. Let's get right in there and let's take a look at the reason why. Let's open up the charts right here. And it has to do with the bond market. Now, what we're going to look at is bonds here. We're going to start with the United States Treasury bond. And what we're seeing here is a rate of the U.S. 10-year at 1.64. And we're looking at the 20 years higher than the 30 years. It's over 2%, 2.04%. Now, that's the yield you're going to get of your money for a year. The thing about it is what are they going to get with other countries here? Let's go over and take a look at the United Kingdom. Their treasuries is much lower. Their 20-year, they only get 1.17. And all the way across the board. Now, which currency are you going to want the most? What's the most popular currency out there? The most solid place that you could, if you're a bond investor, you're looking at investing in treasuries, the most solid place to put your money would be in the United States, probably. It's the de facto world reserve currency, and they're paying a higher rate of return. Look at the United Kingdom's rate of return here. Much lower. Now let's go over and take a look at Germany and their rate of return. And it's even lower again, some cases negative. 9-year, it's less than 1%. It's negative 0.34. Negative 0.14 on the U.S. Germany 20-year. And you're not going to earn nothing on Germany's bonds, the German Bund. Let's take a look at Italy here. Even Italy, with all the debt that they have, they're still substantially lower than the U.S. Treasury. Italian 15 years only paying 1.4%. Okay, so the U.S. is beating them. They're beating these countries as far as what are you going to get in your investment. Even though it's very low, the United States government bond pays a very low dividend. It's still beating these other countries by a considerable bit. Let's take a look at France here. France is much lower. I mean, on 15 years, you're only going to get 0.39%. That means the United States is paying like 3 times as much yield on your money. Okay? Take a look at Japan real quick here. Look at this. Japan is only paying for 15 years, they're only paying 0.28%. Much lower. So what's going to happen is even though the Fed's cutting back, there's still purchases coming in on these bonds because it's the highest rate of return from other overseas investors. Money flows are coming in, ebbing in, from overseas because the United States has still got the best horse at the glue factory, basically. They're the best one, see? And so money flows are still coming in. But here's the thing, guys, is the biggest purchaser of United States Treasuries is the United States government. Let's take a look at U.S. Treasuries. Go back to U.S. Treasuries here. The biggest purchaser is the United States government, purchasing through this quantitative easing. Now, because we've got these other inflows coming in from other countries because the United States is paying the best rates on bonds, there's a certain amount of purchasing coming in from these other sources other than the U.S. Treasury. That way the U.S. Treasury can haul back a little bit and still keep up enough purchases. Like if they cut back by $10 billion, the first month. It's still enough to keep the Treasury market going and keep yields low. Okay? The second month, when they cut again, it's going to get a little bit worse because it's going to be felt more. The second cut that they make is going to be felt more than the first cut. And so what will happen is it's going to start to put pressure on yields. It's not going to be until probably the second or third cut before we start to see pressures on these yields to rise because the biggest buyer is leaving the market. That biggest buyer, which is the United States Federal Reserve of Treasuries, if they fully pull out of the market, there's not going to be enough from these inflows from other countries to support that market, simply put. So, as this progresses, we're going to see movement quicker and quicker toward that edge where the yields are going to start to rise on the long end, specifically on the long end of the yield curve. But the yields are going to start to rise on treasuries in the United States ultimately, if they keep going with this. This is why I say I think they're going to get away with the first couple cuts. A first cut, I think they're going to get away with it. But the second cut, it's iffy. And the further they go, the more they're headed toward that edge where you're taking out the biggest buyer of U.S. Treasuries. And, of course, then yields will rise. Yields rise, the stock market is going to be in very much jeopardy. Let's just put it that way, if yields start to rise. Anyway, significantly at all. So what we're seeing, let's get in there and take a look at some other stuff. Let's take a look at silver today. We're looking at silver today. It's down 77 cents, 23.39. Wow. Wow. All I can say is wow. Have we ever lost our way from fundamentals in the markets? Are we ever wandering in the woods out there and we don't know we're lost yet? The whole world right now. This is a total unmitigated mess in the financial systems that can't be straightened out without tremendous turmoil occurring. And, you know, the day of reckoning is coming really quick, guys. Really quick. We're looking at a silver price of $23.39 today. Let's take a look at gold. Gold today is $17.80, and it's down to $17.80 on the day so far. Now let's take a look at cryptocurrencies. It was 26.06 the last time I refreshed the page. Let's see which way it's moving. 25.96. It's moving down. Looking at 57,299 for a Bitcoin today. We reached the peak of all of this COVID-related money printing, or COVID-related monetary creation monetary units, because they don't really print so much money anymore. In fact, the printed money only represents a very small fraction of the actual money that's on the system out there. It's basically just a floating ledger. You know, that's basically what the money system is out there right now, is a floating ledger. So what they do is, if you got, say, $1,000 in the bank, you take $100 out, they just change the ledger entry. That's all it is. It doesn't exist in the real world. It's just digital units now in the system. That's what we call money. That the Federal Reserve creates through this bond Ponzi scheme with bonds, you know. And anyway, that being said, money is now debt. All money is debt, you know. And the system wants to deflate. We've got a system that is in a very perilous position. And now the Fed is basically pulling the plug on all these bubbles with this. But it's going to take a little while. What I'm telling you guys, it's not going to be right away sort of thing. When I say that they'll get away with this first implementation of their tightening policy, and they might get away with the second one, they might even get away with the third one. But as they cut deeper and deeper, what they're going to do is, sooner or later, they're going to hit it. They're going to hit the spot where it's going to all start to just roil in. then they're going to say, oh my goodness, what have we done? Well, maybe they're doing it intentionally. I don't know. I mean, can they be that stupid? But yeah, they can. Anyway, this is the way it's going. They're going to keep cutting into this tremendous weakness because this whole thing, all that money creation that they created during this period of time, beginning with the start of the pandemic crisis, all that money that they created reached a peak. Reached a peak a few months ago. That was peak speculation in the markets. Markets were jumping day by day. Everything was going up. Bitcoin was going up. Everything was going up. Reached that peak. Now we're on the decline. It's over the peak. It's over the hump. There's no more money coming. Everybody's getting tight. The Fed's getting tight. All the central banks are getting tight. And, I mean, it's a no-brainer what's coming, guys. What's coming is going to be something very scary, you know. And I think it's going to hit all at once. Timing it, well, the thing is you got to look. I say that there'll be inflows coming in to support the debt market from other countries. But that's not going to last forever, as the biggest buyer of treasuries is starting to wean themselves off. This thing's going to hit all of a sudden. Watch the bond market. And it's going to be a few more months. Maybe a few more months, guys. Probably in sometime inside the new year. Watch the bond market very closely. We're going to be watching it on this channel, and this is going to be epic. When it happens, it's going to be epic. We're going to be watching it very carefully here on this channel, though. Okay. Now let's take a look at the Dow Jones today, which is up 2 points. That's nothing. 35,621. Basically going along sideways today. Let's take a look now at crude oil. Crude oil is up $1.09 at 77.84. They're talking about releasing like 60 million barrels. I think it's 60 million barrels of strategic reserve or whatever, you know. Well, we use 20 million a day. What's that going to last? 3 days? If my math is correct? Anyway. So oil's up. It's up $1.09 today. Okay, let's take a look now at the MOVE index. It's at 79.21 on the MOVE index, and we're looking at it's up a little bit. It's touching that 80 point again. That's a danger point. Tell you guys about. It goes too much over that. It means that the credit markets are a little bit unstable. They can't remove things to support the credit market. They got to keep their eye on that. Bonds and rates today. And we're looking at climbing yields on the U.S. 10-year is at 1.65. It's up 2.8 basis points today. So this is a little extension of what we've been seeing. Like yesterday, we saw these yields starting to rise. Now they're rising again today. We got to keep our eye on these yields now because I could be wrong. Maybe it'll start quicker than I thought. I'm giving them credit. I'm saying, hey, you know, these inflows of capital come from other countries because U.S. Treasury's highest yielding will probably support the market while they start cutting. I'm giving them credit. Maybe I'm giving them credit prematurely. This could get out of control prematurely. You know, I mean, because you know how they are nowadays. They always front run things. You know, and so here we go. We're looking at a 10-year at 1.65. Now it's starting to get up, starting to creep. 20 years at 2.05 and the 30 years at 1.99. We still got that inversion between the 20 and 30 year. And now let's finish it off by taking a look at the US dollar index, 96.53, and going along sideways today. Got a strong dollar out there. You know, and it could get one heck of a lot stronger over the next coming months because it's being compared against, first off, is these other fiat currencies. And also, you have to take into consideration that what the Fed's doing right now is deflationary. They've basically all hauled their horns in. They were pushing money out there. Remember all those stimmy checks and everything else, and they're pushing money out like crazy? Well, they've turned the tap off, guys. It's not even dripping. The tap's not even dripping anymore. They've turned the tap off now at this point. And now they're talking about tightening even things even further into when we've reached the peak of this stimulus money, and now things are starting to turn downwards. So they're doing this into weakness. This is a no-brainer. This thing is going to end really, really bad. And I think it's going to be quick when it comes. And I think it's going to be sometime just inside the new year when it comes. And it's going to hit like a hurricane. There's going to be a lot of fear. I think there's going to be things that they're going to sell. I think there's going to be things that people are going to buy out of that fear. And part of what they're going to buy is into the dollar. They're going to buy into the dollar. And, you know, that's going to be a real wrong move at that point in time, because what they're not taking into consideration is the fact that unlimited money creation, and that's the tool that the central banks are going to use to get out of this situation that they're causing. Something epic is coming. Really big around the pike, guys. Seriously, into next year. It's something really epic. It's really dark. It's an ominous storm. It's a financial storm. And, you know, I'm predicting it for you guys. Something's going to break. And going to break pretty soon. Thank you guys for listening. Like and subscribe. Your notification icon, you know. If you're not getting notified from my channel, click it off and click it back on again. Maybe that'll help it to get working, you know, when I produce videos. And thank you for all your comments in the comment section. I try to read them all. It's kind of difficult, you know, because there's a lot of comments. But I try to read them all. I work at it. Thank you guys for listening, and like and subscribe, and we'll catch you guys in the very next show. Bye-bye.